Hello viewers, this is Muhammad Atif and our today's topic is marginal and absorption costing reconciliation for A level with past paper MCQs. Profit calculated under marginal and absorption costing depend upon change in inventory level. So there are three cases: no change in inventory level, increase in inventory level and decrease in inventory level. First case, no change in inventory level. If there is a opening inventory which is equal to closing inventory, if the sales is equal to production, it means that there is no change in inventory level. So the profit calculated under marginal costing and absorption costing would be same. Second case is increase in inventory level. If the closing inventory is greater than opening inventory or production is greater than sales, then profit calculated under absorption costing technique is greater than profit calculated under marginal costing technique. In such a situation, for reconciliation, profit under marginal costing is added up with the increase in inventory and fixed rates product, and we will get the profit under absorption costing. The third case is decrease in inventory level. If the opening inventory is greater than closing inventory, if the sales are greater than production, then the profit under marginal costing system would be greater than the profit under absorption costing system. For reconciliation, the product of decrease in inventory and fixed rate would be added in the profit under absorption costing system. You will get the profit under marginal costing system. Remember, difference of profit is because of movement in inventories, and it can be calculated by multiplying the movement in inventory with a fixed overhead rate. Now here is the example for the verification of all these cases. In this example, the normal production level is 20,000 units. Fixed cost for the month is production overhead $20,000. Selling and admin overhead are $66,000. Sale price is $20 per unit. Direct material $6 per unit. Direct labor $3 per unit. Variable production overhead $4 per unit. And the variable selling cost is $1 per unit. Calculate the profit under absorption costing as well as under marginal costing. If in the first year production is 25,000 unit and sales is 20,000 unit, it means it is a case of increase in inventory. Production is greater than sales. In the second year, production is 16,000 unit while the sale is 18,000 unit, which means it is the third case, decrease in inventory, as sales is greater than production. And in the third year, production and sales are equal. These are 20,000 unit each, and it is the case of no change in inventory level. First working is the calculation of variable production cost per unit. The variable production cost per unit consists of direct material plus direct labor plus variable production overhead. 6 plus 3 plus 4 is equal to 13. Next working is the calculation of absorbed fixed overhead rate, which can be calculated by dividing fixed production cost by normal capacity. Here the fixed production cost is $20,000 and the normal production capacity is 20,000 unit. So the absorbed fixed overhead rate is $1 per unit. Next is the calculation of full production cost per unit, which is the sum of variable production cost plus fixed rate, and it is equal to 13 plus 1, $14 per unit. Remember, if actual capacity for the period is different from the normal capacity, it causes over or under absorbed overhead. Our absorbed overhead is said to be a situation where we have included more cost than actually incurred. In such a situation, we have to deduct such cost from cost of sale. While the under absorbed overhead means we have included less cost than actually incurred. In such a situation, we have to add such cost to cost of sales. Our absorbed overhead are created when actual capacity is greater than normal capacity. and under absorbed overhead created when actual capacity is less than normal capacity. In the first year, we have sold 20,000 units at the rate of $20 per unit, so the total sale revenue is $400,000. Less variable cost of sale, as we are calculating marginal costing first year profit. This is the variable cost of sales consists of opening stock plus production minus closing stock. Because it is the first year, there is no opening stock. We will start from production. We have produced 25,000 units at the variable cost of production of $13 per unit. And as we have produced 25,000 units and sold 20,000 units, we have 5,000 units in our closing inventory. These units are also valued at variable production cost of $13 each. So we will get the variable cost of sales of 2,60,000. After deducting this cost from the sale, we will get the gross contribution of 1,40,000. As in the first year, we have sold 20,000 units and the variable selling cost is $1 per unit. So the total variable expenses are $20,000. Subtracting this from the gross contribution of 1,40,000, we get the contribution of 1,20,000. And from this, we have to deduct the fixed production overhead and fixed selling and administrative overhead to get the net profit figure. Now in the first year calculation of absorption costing profit, sales is $4 lakh less cost of sales. In this cost of sales, we have to record the production at the full production cost, and this is $14 per unit. Production less closing stock gives you a cost of sales of 2,80,000, but as our actual capacity is greater than normal capacity, we have produced 25,000 units and our normal capacity is 20,000 units. So it creates an hour absorbed cost, and the amount of hour absorbed cost can be calculated by multiplying this 5,000 units with $1 per unit fixed rate. Hence the cost of sales comes down to 2,75,000, and then subtracting this cost of sales from sales, we get the gross profit figure of 1,25,000. Then we have to subtract the selling overhead. These are 20,000 and administrative overhead, which are 66,000. And after deducting this, we will get the cost of 39,000 profit. Reconciliation. As production is greater than sales, this is the second case of increase in inventory level. Profit under marginal costing is 34,000. Increase in inventory is 5,000, as opening inventory is nil and closing inventory is 5,000 units. There is said to be increase in inventory of 5,000 units. This increase in inventory of 5,000 units, when multiplied with a fixed rate, gives you amount of 5,000. Adding this to the profit under marginal costing, you will get the profit under absorption costing system. In the second year, we have sold 18,000 units while produced 16,000 units. So in the marginal costing system, sales revenue would be 3,60,000 less variable cost of sales, which is opening stock, which is the last year's closing stock of 5,000 units at the rate of variable production cost of $13 plus production of 16,000 units at the rate of production variable production cost of $13 per unit less closing stock of 3,000. This closing stock of 3,000 is calculated as we have 5,000 units in opening stock, produced 16,000 units, so we have 21,000 units available for sale, out of which we have sold 18,000 units. So there are 3,000 units remaining in the closing inventory. These are valued at $13 per unit of variable production cost, and we'll get the variable cost of sale of 2,34,000. Subtracting this from the sales, we'll get the gross contribution of 1,26,000 less the variable selling overhead, as we have sold 18,000 units and the selling cost is $1 per unit. So the total variable selling overhead are 18,000. Subtracting it from gross contribution, we will get the contribution of 1,08,000. And then in the marginal costing, we have to deduct all the fixed costs, whether it is production cost or selling and admin cost, to get the profit of 22,000. In the absorption costing system, sales revenue remains the same while the opening stock is valued at full production cost of $14 per unit. and the cost of sales before adjusting the under or over absorbed overhead is 2,52,000. But in this year we have produced 16,000 units while our normal capacity is 20,000 unit, so we have produced 4,000 unit less than our normal capacity, and it is the cause of under absorbed overhead. The value of under absorbed can be calculated by multiplying this under absorbed quantity of 4,000 unit by the fixed rate of $1 per unit. So the cost of sales would be increased by this 4,000 of under absorbed overhead, and it comes as 2,56,000. After deducting this cost of sales from the sales revenue figure, we will get the gross profit of 1,04,000. Then subtracting selling overhead and administrative overhead, we will get the net profit of 18,000. For reconciliation of profit, as production is less than the sales, this is the case 3, which is known to be a decrease in inventory. Profit under absorption costing is 20,000. Decrease in inventory is 2,000, as we have 5,000 unit in opening inventory and 3,000 unit in closing inventory, so there is a decrease of 2,000 unit in inventory level. And this decrease in inventory, when multiplied by the fixed rate, gets the value of 2,000. 20,000 plus 2,000 gives you a profit under marginal costing system. And in the third year, we have sold 20,000 unit and produced also 20,000 unit. 20,000 unit at the rate of $20 per unit, the total sale revenue is 4 lakh. Closing stock in the last year is 3,000 unit. This is the same the opening stock for this current year of third year. Plus production less closing stock gives you a cost of sales of variable cost of sales of 2,60,000. After deducting this variable cost of sales from sales figure, we will get the gross contribution of 1,40,000 less variable selling overhead of 20,000 gives us a contribution of 1,20,000 less the whole fixed production cost and whole fixed selling cost gives you a net profit of 34,000. In the absorption costing, the sale revenue remains the same. Opening stock plus production minus closing stock gives you the cost of sales. Remember, there is no over or under absorbed overhead, as our actual capacity is equal to normal capacity of 20,000 units. So in the third year, after deducting all expenses from the gross profit, we will get the net profit of 34,000. And hence the profit remains the same in whether we are using marginal costing system or absorption costing system, because there is no change in inventory level. Remember, profit figures remains the same if there is no change in inventory level. Now the MCQs of the past paper of A levels. First is, which statement about marginal costings are correct? The marginal cost of product include an allowance for fixed overhead? No. The marginal cost of product represent the additional cost of making one extra unit? Right. If inventory decreases during a period, the profit under absorption costing will be lower than under marginal costing. So it is about the third case, and statement is true. Answer will be C. Next MCQs, the following data is available for the period 9. Opening inventory is 10,000 while closing inventory is 8,000. As opening inventory is greater than closing inventory, it is the case of decrease in inventory level. Absorption costing profit is 2,80,000. What would be the profit for period 9 using marginal costing? Remember, change in profit is calculated by multiplying change in inventory level multiplied by fixed overhead rate. Here is no information which can tell us about the fixed overhead rate, so it is impossible to calculate without more information. In the next MCQs, the overhead absorption rate for the product T is $4 per machine hour. Each unit of T required 3 machine hours. We have to compute the overhead rate in terms of unit, and it comes as $12 per unit. Inventory opening is 2,400, closing is 2,700, and it represents increase in inventory level. Compared with the marginal costing profit for the period, the absorption costing profit for product T will be which of the following? As it is the case of increase in inventory level. In increase in inventory level, absorption costing profit is always greater than marginal costing profit, and the difference can be calculated by multiplying the fixed rate by change in inventory level. Here in this question, increase in inventory is 300 unit while the rate is $12 per unit. So difference of profit is 3600 and the profit would be greater in absorption costing system when there is an increase in inventory level. Option would be B. In the next MCQs, in a period where opening inventory were 15,000 unit and closing inventories were 20,000 unit. A firm had profit of 1,30,000 using absorption costing. If the fixed overhead rate was $8 per unit, the profit using marginal costing would be which of the following? As closing inventory is greater than opening inventory, it is a case of increase in inventory where absorption costing profit is greater than marginal costing profit. And it can be calculated as ACP means absorption costing profit is equal to MCP plus increase in inventory into fixed rate. By putting all the information in the question, we will get the marginal costing profit of 90,000. In the next MCQs, in a period, a company had opening inventory of 31,000 unit and closing inventory of 34,000 unit. Profit based on marginal costing were $8,50,500 and absorption costing profit is $9,55,500. If the budgeted total fixed cost for the period was $18,37,500, what was the budgeted level of activity in units? First, we have to identify is that increase in inventory level or decrease in inventory level. As opening inventory is less than closing inventory, it is an increase in inventory level case, in which we can use a formula of ACP is equal to MCP plus increase in inventory into fixed rate. By putting values into the formula, we will get the fixed rate of $35 per unit. Now by using another formula of fixed rate, which is fixed overhead divided by normal capacity, we can calculate the budgeted capacity of or budgeted activity of 52,500 units. Next MCQ is a company had opening inventory of 48,500 unit and closing inventory of 45,500 units. Profit based on marginal costing is $3,15,250 and absorption costing was $2,88,250. What is the fixed rate? First, we have to identify whether it is an increase in inventory or decrease in inventory. So, as opening inventory is greater than closing inventory, it is a case of decrease in inventory level. And for decrease in inventory level, formula would be MCP is equal to ACP plus decrease in inventory into fixed rate. By putting values into the formula, we can get the figure of $9 per unit of fixed rate. Next MCQ, a company has established a marginal costing profit of 72,300. Opening inventory was 300 unit and closing inventory is 750 unit. The fixed production overhead absorption rate had been calculated as $5 per unit. What was the profit under absorption costing? Again, first we have to identify whether it is an increase in inventory case or decrease in inventory case. Then we have to put a formula ACP is equal to MCP plus increase in inventory into fixed rate and get the value of 74,550 of profit under absorption costing. Next MCQs, a company which uses marginal costing has a profit of $37,500 for a period. Opening inventory was 100 unit and closing inventory was 350 unit. The fixed production overhead absorption rate is $4 per unit. What is the profit under absorption costing? Again, cases increase in inventory level, formula would be ACP is equal to MCP plus increase in inventory into fixed rate. Next MCQ, a company manufacture and sell a single product. For this month, the budgeted fixed production overhead are $48,000. Budgeted production is 12,000 unit. So with the help of this information, you can calculate the budgeted fixed rate. And budgeted sales are 11,720 unit. The company currently using absorption costing. If the company uses marginal costing principle instead of absorption costing for this month, what would be effect on the budgeted profit? As budgeted production is greater than budgeted sales, it means it is the case of increase in inventory level. And in increase in inventory level, we just have to consider what is the difference of profit. Difference of profit can be calculated by multiplying the fixed rate with a change in inventory. Budgeted production 12,000 unit, budgeted sales 11,720 unit. So there's an increase of 280 units in this particular period. Multiplying this by the fixed rate of $4, which can be calculated by dividing 48,000 overhead with a budgeted production of 12,000 unit. we get the difference in profit of 1120. As it is a case of increase in inventory, profit under absorption costing would be higher than the marginal costing profit. Next MCQ, last month when a company had an opening inventory of 16,500 unit and a closing inventory of 18,000 unit, the profit using absorption costing was 40,000, fixed production rate is $10 per unit. What would the profit for last month have been using marginal costing? As it is a case of increase in inventory, profit can be calculated by putting the information in the formula of ACP is equal to MCP plus increase in inventory into fixed rate. Next MCQs, last month a manufacturing company's profit was $2,000 calculated under absorption costing principle. If a marginal costing principle has been used, a loss of $3,000 would have been occurred. The company's fixed production cost is $2 per unit. Sales of last month are 10,000 units. What was the last month's production in unit? As we can judge, the absorption costing profit is greater than marginal costing profit because we have sustained loss while calculating profit under marginal costing system. It means that absorption costing profit is greater than marginal costing system. It means it is a case of increase in inventory level. By putting the remaining information into the question, we can calculate the value of increase in inventory, which is 2,500. Increase in inventory can be calculated by subtracting sales from production. If production is greater than sales, it is the case of increase in inventory. So it can be said production minus sale is equal to increase in inventory. So by putting information into this formula, we'll get the production, which is 12,500 units. In the next MCQs, HMF company produced a single product. The budgeted fixed production overhead for the period are $5 lakh. The budgeted output for the period is 2,500 unit. Opening inventory 900, closing inventory 300. As it is a decrease in inventory case, we have to calculate the difference in profit by multiplying by decrease in inventory with a fixed rate. Fixed rate in this question can be calculated by dividing 5 lakh budgeted production overhead with a budgeted output of 2,500 units. In the next MCQ, a company uses absorption costing and makes and sells one product. In the last month, budgeted overhead total $60,000. Budgeted production was 15,000 units and budgeted sales for 14,000 units. The company now decided to apply marginal costing principle for the last month. Which effect will this have on profit? As we have to identify, it is a case of increase in inventory, and an increase in inventory, profit difference can be calculated by multiplying increase in inventory with a fixed rate. Here fixed rate can be calculated by dividing budgeted overhead of $60,000 with a budgeted production of 15,000 units. Increase in inventory is 1,000 unit as we have produced 15,000 unit and sold 14,000. So we have 1,000 unit in closing inventory while there is no unit in opening inventory. So it is a case of increase in inventory. And the last MCQs is the following information is forecast for May. Opening inventory 25,200, closing inventory 28,200, which means increase in inventory. Marginal costing profit is 1,800,000, absorption costing profit 1,20,300. What is the overhead absorption rate? As it is the case of increase in inventory, the formula used to calculate the rate is ACP is equal to MCP plus increase in inventory into fixed rate. So this is the reconciliation of marginal and absorption costing with the solved MCQs of past papers of A level. Hopefully it will help you out. Do give your feedback and subscribe the channel.